Hello traders, Nick with Vant Trading here, and I'm here with another stock trading educational standalone video. Today I'm going to be talking about SPACs, or those blank check companies, because this year has been absolute SPAC mania. If you have been day trading, if you have been investing, if you've just been watching the markets, there is a very little chance that you have not seen these SPACs go absolutely crazy. It has been some of the most lucrative day trading opportunities in the market this year, and we've seen it actually overtake the traditional IPO process in the market this year. And so we're about to go into a new year, and so we got to wonder, well, where is this going to go from here? You need to jump in on this train if you're a day trader, or potentially if you're a long-term investor or speculator, because there's a lot of opportunity here. And we've gotten a lot of questions on, well, what is a SPAC? I don't understand how this works. What do I buy? What do I look at? What am I supposed to read? How does this work? So our plans for this video are going to be to help provide an understanding of what SPACs are. I want you to walk away with an understanding of this weird acronym. I want to discuss why they've blown up this year. Why has the number of SPACs that has IPO'd this year gone multiples of 4 or 5 times what we've ever seen in the past? And what is the implications of SPAC mania going into 2021? And then what are some of the ways that you can trade these things so we can better prepare ourselves for whatever is to come in this sector? And I want to talk about this because people might be like, yeah, I've seen it, but is it really a thing? Like, is it really blowing up? Is SPAC mania overblown? Yes, it is a thing. SPAC mania, and this is pulled from SPACanalytics.com. You can do your own research and see if that's something you want to use. But in 2020, the SPAC IPOs have so far been 234. I don't think we've ever seen them eclipse 70 in the past, the SPACs in a single year. In fact, that's over 54% of all IPOs this year. The SPACs alone have raised almost $79 billion, and the most we've seen prior is $13 billion. That is it. We are talking absolute mania this year. It has blown up in popularity. Everyone out there has their own SPACs these days, and so it's providing a lot of opportunity, not just for investing or swing trading, but for day trading. And a lot of interesting moves have been made because of SPACs. So let's talk about these. Well, first off, I want to remind you that, this video is supposed to be introductory. I'm not going to teach you the most advanced, convoluted things you can imagine. I want you to walk away and be able to hold a candle to whether this is this something for me? Do I want to trade SPACs? Is there opportunity here for me? Is this something that might interest me? And then you can do a little more due diligence. But first off, what is this weird thing I keep saying, SPAC? What is a SPAC? Well, it stands for Special Purpose Acquisition Company. That may seem a little strange, but it has a purpose. It's literally what some people call it, a blank check company. So if someone ever refers to a blank check company or a blank check shell corporation, this is usually what they're talking about. And the literal purpose of the SPAC is to come into the market and then buy another company or merge another company. And what they do is they buy that company or they merge that company, and then they IPO under that quote-unquote new ticker. So a SPAC IPOs over the next year or two. It finds a company to buy. It buys the company. That SPAC stops trading, and the new company has now become public. So this has essentially become a hot new way to take a private company into the public space without having to go through the traditional, costly, and time-consuming IPO process. So what happens, what happens if this SPAC can't find a company to buy? Well, if the SPAC traditionally does not acquire another company in 2 years, it returns its investors' funds. It doesn't go to zero. It doesn't stay there in perpetuity. What happens is, and sometimes they can go to the SEC and say, hey, can we have more time, or can we extend our prospectus? And sometimes this SPAC may only last a year and a half or two or a single year. You need to double check, because look, every single one isn't going to have the exact same rules, regulations, requirements. They're all based on different things, and it's all in their prospectuses. Now, the details of who they acquire in the merger acquisition is not going to be laid out explicitly. They're not going to say, we are going public with the anticipation of buying this company. No, what they do is sometimes they'll give you a little hint and say, we are focused on the energy industry, or the financial industry, or we've got some specialty people on our back end that are going to focus on this. And so you can find that in public documents called the prospectus, and I'll teach you how to find those in a moment. But at its core, the SPACs are just here to take investors' money, buy some other company, and then combine and merge with it, and then take that public. And they get, some management fees for that. They then help run and control a company in the now public space. It's just a fancier, faster way of IPOing a company. So how does this work? What happens with the money that goes into a SPAC? Well, when a SPAC IPOs, this special purpose acquisition company, when that company IPOs, it obviously is getting money from investors in anticipation of acquiring someone. The money that the SPAC raises in its own IPO is then going to be used to merge or acquire another company. So what do they do with that company in the meantime while they find a company to acquire is it's placed in an interest-bearing trust account. They don't just get to spend this money. It's protected by third parties. So the investors who invest in this SPAC have their money protected. And if they fail to merge in 2 years, they take the money out of the interest-bearing trust account, they shut down the SPAC, and they give their investors their money back. Now, you got to keep in mind that there is some fees and costs in there, but it's usually minimal. They outline it all in the prospectus. But, even if an agreement is reached, it's important to note that the SEC needs to have approved that merger in those 2 years. So after the agreement of the merger happening, it might take a couple of weeks for the SEC to approve it and for that merger to officially happen. It's not some long drawn out process because they only have a shelf life of 2 years. So there's generally quicker turnaround. Now, generally, when you're looking at a SPAC in the market that hasn't acquired anyone yet, what's it going to look like? Well, it's going to look like a stock that is just trading around $10 a share and is refusing to move. That's because generally the standard value of liquidation for these companies is going to be around $10 a share. So if you're looking at a stock and it's just trading around $10 and not moving, you're like, what the hell is this? It's probably a SPAC because if you buy that company and in 2 years when that time is up, if they haven't found anyone, you're going to get liquidated at probably about that $10 a share. Now, it does vary per company, but generally it's $10 a share. Now, SPACs also include other aspects to it. They have warrants. They almost always have warrants involved. This is a little more complex, and I'm going to talk about how you can trade with their warrants in a moment, but I just want you to know that. And then the people who are managing the SPACs on the back end usually get a percent of the value regardless of the income. And it's usually, I think, around 2%. I don't know what it is these days, especially after SPAC-mania, but that's just kind of how it works. They're just kind of like the hedge fund managers or such. They run it so they get a little piece and they help run this whole thing. So when we're talking about SPACs, I want you to keep in mind that it's important to note that many SPACs combine with larger companies. So if a SPAC IPOs and they have $100 million in their war chest to try to acquire someone, they can absolutely and will most likely try to find a company worth more to buy. And then what happens is after they've reached that agreement, there are going to be other deals that are reached on the side, pipe loans, and all sorts of other things that are done on the side. So it's just important to note that it's not necessarily one for one. The company that the SPAC is what they're going to be acquiring, and because of that, the shares trading under the SPAC ticker are usually only going to end up a fraction of the shares that are going to result when that new company IPOs. So, for example, one SPAC, in the past, VTIQ was a SPAC that came out. They bought and merged with NKLA, became that new ticker NKLA. Those VTIQ shares were only 7.3% of the shares outstanding for NKLA, because when that NKLA IPO'd, it was a much bigger company, had more shares out there, and it wasn't just a small SPAC anymore. It's a real company with quote unquote real company with money behind it and more shares. So these are just some things to keep in mind, that the conversion isn't necessarily just one-to-one. The size of the SPAC isn't going to be the size of the company they acquire necessarily. So there's other backdoor dealings and much more complicated stuff that's not worth getting into. Let's just give you a very silly kind of example of a SPAC. John is a very knowledgeable in a certain sector. Let's say it's the real estate market. He knows of several private companies in this real estate market that he thinks are real hidden gems. He's like, if I could take this company and make them public, I could really make some money running this company in the public sector. So he creates a SPAC with a team. He gets a whole bunch of people together and says, hey, I want to create a SPAC. I want to get some investors to give us some money so we can acquire someone in the real estate industry and bring them public and then have this awesome company that's in the public. So then they go to investors and they raise a whole bunch of money to IPO a blank check company. Congrats, they get a whole bunch of investors and a whole bunch of money, and eventually they go quote unquote public with this SPAC. Now, John puts all of the SPAC's money into an interest-bearing trust fund account, and in the meantime, he can use some of the interest that's generated as working capital, but most of that is going to be saved to buy one of those companies that he wants. So in the meantime, he's reaching out to small private companies and saying, hey, we really want to acquire you. We'll pay you all this money, and we're going to take you public. And, I'm sure there's a whole bunch of like, well, management, what are we going to do with that? Dealings in the back end. I mean, look, this is a merger, so there's a lot of negotiations, I'm sure. Now, eventually that deal is reached with someone. The SEC signs off, and a couple weeks later, the business combination is complete, and that company now becomes the new SPAC. If it's a larger company, John may need to take some time to find some extra pipe loans to bridge kind of this money gap or whatever kind of other loans and funding that they need to secure. So there is other processes in the back end. And eventually it's all completed. That SPAC stops trading. A new ticker of the new company is now publicly traded. If you're holding the SPAC, you're converted into shares. And John is now out there running this new company, presumably. Now, that's kind of the general, very basic version of how this happens. Why are SPACs so popular? Why did we see them blow up this year? Well, it is very expensive to IPO traditionally. And, you've got a lot of issues of missed opportunity cost on trying to IPO different ways. And the company that's IPOing, the value of their company on IPO is out of their hands. It's really in the underwriter's hands. And a lot of that power is taken out from them. And it's very expensive, very, very expensive and time consuming to IPO traditionally. And in this case, it's a lot less work. It's a lot less work if, I want to IPO, but I don't want to go through all that. But if this guy buys me and then we just go public that way, it's going to take a whole lot less time and it's going to be a whole lot easier. And also, look, let's just be honest. SPACs are really popular right now because they're popular right now. People are seeing it's an easy way to make some money trying to manage a SPAC on the end. And, maybe you can take an easy company public. Maybe you've got connections with someone, so you already anticipate taking this company public when you SPAC. There's a lot of hype involved. And so you're getting a lot of momentum valuations involved with these SPACs as well. Let's be honest. Some of this is just fugazi. It's just kind of hype and momentum. So I mentioned those SPAC warrants. I want to go over those because that's kind of an important part of this, especially if you're looking to invest in SPACs. If you're looking to day trade SPACs, you don't really have to worry about these, but I want you to be aware of them. So if you ever see them or maybe it interests you later. So first of all, what is a warrant? Well, if you know what an option is, if you know what options are, then you understand a warrant at its basic core. A warrant is like an option, but it actually trades like a stock. So what happens is it provides the owner of the right, not the obligation. You buy those warrants, you can convert those warrants and exercise them, and then you get to buy shares of the underlying stock at a predetermined price per warrant. So it's exactly like an option, except it's going to be like a stock, and you don't have to convert them. Obviously, they can expire worthless, so you do whatever you want with them. Now, typically with SPACs, if it's a $10 share SPAC, it'll be an $11.50 valuation of conversion with these warrants, and they usually have a 5-year term after any merger is consummated. So what I'm saying here is that, if the SPAC is trading at $10 and you buy the warrants in anticipation of, this stock being really popular and blowing up, and eventually that merger is going to complete, you can then redeem the warrants that you've been holding, and regardless if that new company is trading at $100 a share, you have the right to buy those shares at $11.50. So you get instant profit there. Now, there are things to keep in mind. They expire worthless if the SPAC expires after 2 years. You do not get paid out from that fund, that interest fund, like if you held the stock. It's a complete gamble. That's why you have so much more upside in some ways. It is a much bigger gamble, and there is risk associated, obviously. Also, they are only exercisable usually if after the merger and business combination is completed. You buy those warrants, you can't exercise them if the SPAC itself has gone to 50, if that merger hasn't completed yet. So that's important to keep in mind as well. Now, yes, you can sell those warrants back out into the open market and just get rid of them. You can't exercise them. That's what I'm saying here. You can buy and sell them like a normal stock. That's perfectly fine. And they will typically trade as the same ticker as the SPAC, but with a W at the end. So if the SPAC is MCNL, you can type in MCNLW and you'll see the warrants. They'll look just like a stock, maybe a little more thinly traded. Now, obviously, these are more speculative and it can lead to more volatility in their price action and price movements. And I want you to keep in mind a couple of things. The terms of warrants can vary between companies. Do your due diligence if you plan on buying them and investing in them. Read the prospectus. Also, warrant terms can change. They can come out there and change the expiration dates and such. And if you weren't paying attention, you just tuck them in your back pocket, they could expire worthless without you even realizing. Many times also, a lot of brokers out there won't automatically exercise things for you. You need to call them, figure out if there's fees associated with that, figure out what that process is to have your broker exercise them for you. Some brokers don't even allow warrant trading. I'm pretty sure Robinhood does not allow warrant trading. I could be wrong, but if those tickers aren't showing up, it's because your broker doesn't allow you to trade or invest in warrants. So keep that in mind. But I want you to know what they are, because what will typically happen is you'll have several types of tickers with each SPAC. First, you'll have the initial stock IPO of the SPAC. And these initial units are actually comprised of usually one share of common and a portion of warrants. So the value of these initial units is actually a little stronger. And that's going to come out with a U at the end typically. So like MNCLU. So MNCLU IPOs, this SPAC has hit the market, it's trading, and it's hanging out here at a valuation, and some time goes by. Eventually, that SPAC can separate out its warrants and common shares to be two independently traded items. And I feel like 99% of the time they do this. And this will become MNCLW and MNCL. So now you have three tickers out there in the market for the same things. MNCL, which is just the shares, MNCLW, which is just the warrants, and MNCLU, which is a varying combination of the two. Now, that should mean that MNCLU should be trading slightly higher than MNCL because it also includes the warrants and has a little extra potential in it, obviously, for profit. Now, if that thing expires worthless, I don't know the exact conversion, but if you're holding MNCLU, your warrant portion of that will expire worthless, but the common share portion won't. So what happens if you hold the warrants into the merger? Well, there's a varying degree of things that can happen. In some cases, you can convert those warrants immediately into the equivalent value of stock in some cases if you don't want to put any more cash to buy the shares. Otherwise, the warrants usually convert to warrants of the new stock ticker. And, what if the warrants can convert, but you don't have the money? Because, yes, it gives you the right to buy at $11.50, but you still need to have the money to shell out and buy those shares. Then, you can sell some of those warrants back at the market and acquire the stock, do whatever you want to do there. But this is important to know because, when you're trading these SPACs, you might see multiple tickers of the same thing, but with a different letter at the end. This is what the difference is here. So it's important that you keep that in mind. Examples of recent SPACs out there: Space, if you know what that one is, that was Richard Branson's Virgin Galactics, I believe. DraftKings, DKNG, that's obviously a big company a lot of people have heard of. NKLA, very hot in the headlines, ran astronomically and has since crashed. People are calling it a fraud. And PSTH is one that is a SPAC that's IPO'd, but they have not completed a merger yet. This is Bill Ackman's SPAC, and I wanted to point this one out because it's actually trading with I believe a liquidation value of $20 a share. So if you pull that ticker up, you'll see something a little different. And it's the largest SPAC ever. They raised billions of dollars just IPOing this SPAC alone. They haven't even acquired anyone yet. We've seen several other SPACs this year. We've seen Playboy SPAC this year. So Playboy's now going public. Michael Jordan has his own SPAC, I'm pretty sure. I'm pretty sure Shaquille O'Neal has a SPAC. So there's so many out there. We've seen the Mania hit. You've seen so many small price ones. And most of these are still just out there looking for someone to acquire. Now, many of them have bought people like DraftKings, like Space, like NKLA, and we're going to talk about some of those. But before we do that, just give you a little more knowledge here. Sometimes a shareholder vote might be required to approve the merger, so that is a little obstacle or hurdle in your way that you need to be careful of. One thing that if you plan on investing in these things or doing anything crazy with them, find the prospectus and read it. For the love of God, protect yourself and know. If you invest in one, you need to become familiar with it. That little link I put down there, you can also Google it, Edgar, EDGAR. You can search companies by ticker, and then it's through the SEC. It pulls up all of their public filings. You find the prospectus, you read through it, and you understand all of the terms and conditions. The SEC, I put that link down below, also has a what you need to know about SPACs investor bulletin. I'm very glad they put put that out there. I recommend everyone read that and do their own due diligence, especially if they plan on investing in these a lot more. If you plan on day trading, really knowing the ins and outs isn't going to be that important. Let's be honest. You're not holding warrants, you're not converting anything, you're in and out in the same day, so you should be fine in that case. But it's also just important to know what your downside is, what valuation is, and what, you shouldn't be trying to short a SPAC below $10 until after it's IPO'd, obviously. So we've talked about SPACs. We've talked about how appealing it could be for some companies. What's the downside to investing in these? It sounds like easy money, right? Well, there is a big opportunity cost. What if over the next 2 years you've invested in this SPAC hoping it's going to buy someone and blow up because it buys someone awesome, and the market's rising, and over the last 2 years maybe the market goes up 12%, and that SPAC fails and the SPAC liquidates? That's fine. You protected your capital, but you only got 2%. And the whole time you had your money tied up, you could have been day trading, you could have been investing in other things, you could have been moving your money around, you could have done a lot of things. SPACs historically, and this is prior to this year, so I'm not sure, it might be a little higher now, but SPACs historically perform at a negative interval, -3% a year. And that's because most SPACs that go out there are still looking for people to buy. We had 280 SPACs come out this year. You think all of them are going to find someone in 2 years to acquire and go public with? Hell no. And even a lot of the ones that do, the companies are probably going to be crap, and they're going to sell off as soon as they IPO, and they're going to be dog shit companies. So that's important to note there, especially with the hundreds of SPACs we've seen flood the market. Most of them are probably not going to do anything. The more SPACs we're seeing, the less appealing they're starting to become from an investing standpoint. It just is going to require a lot of due diligence. What if your SPAC ends up investing in a fraud company? I talk about NKLA, and I don't know really, are they frauds? Are they not? I don't know. But if you bought and you're holding, you're trying to hold through the company merger and into the new company, what if that person ended up buying and going public with a really shit fraud company? Well, your valuation could eventually go to zero, because look, there is less due diligence in this than in the traditional IPO process. I mean, you could look at NKLA. There have been maybe not hundreds, but dozens of electric car vehicle companies that have gone public through SPACs this year. Do you really think that they're all going to be the new Tesla or the big mover and shaker in the market? No, a lot of these are going to be cannon fodder for the big boys. They're going to get gobbled up, or they'll just go under and it'll be nothing. So that's important to keep in mind, that if you're investing in the SPAC to try to just ride into the hype, that's one thing. But if you're investing in the SPAC and then that investment in the SPAC becomes an investment in whoever that SPAC becomes, that's another thing. There is, like I said, there could be possible future regulation coming to this process. This is people are fast tracking the IPO process this way. And like I said, once that SPAC buys someone, if your shares get converted into that new company can go to $0. That new company does not have a $10 cushion anymore. There is no valuation protection. There is no payout if it goes bankrupt. Once the SPAC has bought someone, that SPAC goes in the shredder, and now it's a company like DraftKings. DraftKings can go to zero. It can go bankrupt. And the SPAC that runs them now is no longer a traded ticker, and that protection no longer applies. So keep that in mind. So when you're trading SPACs, look, you can obviously still invest in a SPAC long term. You obviously just it takes a lot more due diligence. You could invest in the SPAC warrants. You could buy the stock just to sell into the news spike of them announcing they're acquiring someone. You could take your stock in the new company if you like who they're buying. There's a lot of ways you can invest in SPACs and a lot of things you could do there. You need to do due diligence, especially with how many are in the market now. There are big names in the SPAC industry. Bill Ackman's SPAC is probably appealing to a lot of people, and there's a lot of big names that are entering this market. SPAC merger announcement usually provides a gap to some degree. So it's trading at $10. They announce, hey, we're buying someone. That $10 will usually gap up to 11 or 12. And that'll obviously provide some day trading opportunities. Or you could just be buying those SPACs in anticipation of that and trying to catch it at the right time, right place. That's obviously a lot harder to do. If it's a hot SPAC in a hot sector, like the electric vehicle sector this year, it could run. We saw SPACs go from $10 to $100. I mean, I'm not kidding you. This is, before the company's even acquired, and at that point, the SPAC has just become a Momo stock and a Momo trader. So there's a lot of day trading opportunities. Did the SPAC raise incremental capital in conjunction with the merger? This is an interesting statistic I saw. I don't know how accurate it is at this point in the year or whenever you're reading it, but At the time I made this, SPACs that did not secure PIPE loans are down an average of 42% after merging. And a PIPE is a private placement of public equity. It's just getting that additional capital to get a bigger merger than what your value is. So, that is something to keep in mind is, were they able to get more loans and stuff and buy someone big and get a real company? So there's a lot of stuff to take in mind when you're trading SPACs. Day trading SPACs. Well, what we recommend you do is just have a little running list on an Excel, on whatever, of all of the hot ones. What are the ones that are going out? That way you can periodically, maybe at the beginning of every week, cycle through some charts, see which ones are running or in play. And at that point, we like trading them like IPOs, trade them like hot stocks. Because at this point, when the SPACs are gapping up, past $10 and they're running on news, there's no other levels to trade them off of, and you can get a lot of opportunity there. We recommend you do a lot of momentum-based trading in these SPACs. We don't like holding them overnight because they are prone to headline risk and they are very volatile in some cases, especially when they're really crazy fast-moving ones. It's the same as trying to take some low-float pump and dump up to an extent where you have a lot of risk if you try to take these overnight in either direction. But they provide fantastic day trading opportunities. How do you day trade them? Just day trade them however you day trade. If you're a successful day trader, you'll be able to day trade SPACs because the setups, the indicators you can use, the formulas, the outputs, whatever, it all should remain the same. At this point, they start trading like a normal company to an extent. Like I said, you could try to speculate taking SPACs into an announcement in a hot market based on perspectives. I've seen people do this on Reddit. I saw so many Reddit posts during the summer of, we're seeing electric car vehicle SPACs are really hot right now. Well, here are all of these SPACs out there that, at least in their prospectus, have said that they're interested in energy sector or the energy industry. And then maybe you buy some of each, or you weigh your options, look at the prospectuses, look at how much time's left, look at who's managing them maybe, and try to figure out, well, which one is most likely to announce next that they're going to acquire someone. You could try to front run like that. Obviously, that's going to take a lot more time, and the payoff could be really good with favorable price entry, especially if it becomes a hot one. But you got to have a system for that. But you don't even need to. There's so much day trading opportunity off of these. So where do we think that this SPAC mania is leading to next year? Well, obviously we think it's leading to more SPACs in 2021. This process and this trend is continuing to accelerate into the end of the year, and it's not slowing down. Maybe we'll see some new hot sectors in SPACs next year. Maybe we'll see the marijuana industry start to hit a whole bunch of SPACs next year now that Biden's president. Maybe we'll see tech, maybe real estate. Who knows? This year was electric vehicles all the way on SPACs, baby. You saw so many. And that's not to say that's all that there was, but that was a lot out there. We might start to see a whole other sector become hot, just like in day trading. Now, this is an interesting little thing I want to call out and call your attention to. When you're looking at previous SPAC data, the last time the SPACs peaked, and it was not to the extent of this is a much larger peak, was in 2007, right before the financial crisis. And the only reason I say that is because, this SPAC mania is kind of a sign of exuberance in the marketplace. I mean, this is insane, the amount of SPACs we're seeing out there and the amount of money that's being shelled out. And partially it's because, interest rates are so low and people are looking for return and looking for stuff like that. But, looking for easy money and safe money, quote unquote, safe money. But, you got to keep that stuff in mind, and you got to be trading defensively. This could mean that we see a lot of merger mania in the next 2 years. Goldman Sachs says that they see, at least one of their analysts sees at least $300 billion in merger and acquisition activity over the next 2 years as a result. Think about it. All of these companies, these small companies, are being bought and brought public. This is easy acquisition and gobbling up fodder for a lot of other larger companies now. Now, the SPAC people who have bought this company and taken them public, what if a big company comes along and says, hey, we want to buy your now public company for a whole bunch of money? The SPAC manager is going to be like, hell yeah, I got paid for managing the SPAC. Now I get paid for, selling the company that I bought at an even higher valuation because I was a genius and took them public. So we could see a whole lot of speculation opportunities going into the next year or two, a whole lot of speculation on which ones are prime candidates to be acquired by Tesla or Amazon or whoever. So there's going to be a lot of interesting merger movements and day trading opportunities, merger arb opportunities, whatever, coming in the next year or two most likely as a result. So it's definitely going to be something to keep an eye on. Let's look at some chart examples of SPACs because I just want you to see what do they look like. What does it look like when they announce this news, and what did some of these stocks do this year? This is the first one. It was KCAC, and then they eventually completed the merger. Now it is QS. Got to keep that in mind because sometimes they change tickers, sometimes they keep it, sometimes you'll pull it up and you won't be able to see the previous SPACs trading activity, just the new stocks trading activity. It varies. Regardless, look at QS or KCAC prior to the announcement, trading at $9.74, just below $10 a share, not moving because that's the liquidation value. They announce the merger. We get a nice little pop from just under 10, goes up and closes at $18 a share. Nice volume spike. It obviously became a great day trader. I don't need to go in here and show you all of the days of day trading because you could have found day trading opportunities in a lot of these days. Now, like I said, they announced the merger. Great. Now we have some time that has to go by until, they reach an agreement. Eventually, down the road was this. 2 months later, they set a date for a meeting to approve the combination, November 25th. So we're getting a little more action here. People are getting interested in it again. People are starting to speculate, well, if this approves, maybe we'll pop. It starts running up. Bam, overnight right in here, they approve the merger, and we're off. And it's now become QS. What did QS do in the following days? It's gone pretty crazy here. Look at this. So this SPAC, which was originally $10, gets a nice 100% gap, more or less, on the merger news, trades for a while, it approves, and now we go from 25 up to 90. Now, this was, I believe, another electric vehicle one. This is obviously Momo. This isn't some new big company. To my knowledge, I don't know the fundamentals of this one. I've just been day trading it, but you better believe that the last month or so has been great day trading these guys. And in that case, you can take whatever day trading strategy you like and apply it to these in a lot of cases. Just realize that they're hot and they're fast, and they can be very whippy and dangerous. Let's look at another one, NKLA. Now, for those who haven't seen this one, brace yourself. For those who have, you're probably laughing looking at these early charts. NKLA trading at $10, doing nothing. They announced, and it was originally VTIQ. Now it's NKLA. They announced they're acquiring NKLA, get a little pop. We wait a little bit of time. They eventually approve the merger. Now we're NKLA. Look what it did. Whoop, went all the way up to $94 after the merger. That is just Momo insanity. It is not worth that, obviously. Look, it was some company. And look what we've done since then. We've come all the way back down. Now, why did it do that? Well, it turns out maybe this company's a fraud. They've lost a lot of contracts, apparently, that made them appealing in here. Looks like they were defrauding people, possibly. I don't, who knows what the truth is. A lot of people have done a lot of due diligence on this. But if you bought the SPAC and invested in it and then wanted to, turn that investment into NKLA, you've seen that investment evaporate. So it obviously provided a whole lot of day trading opportunities in there. Now let's show you that they don't always go up. This is space. This is Virgin Galactic Holdings. It was hanging out at 10. They give you the announcement. It pops a little bit. It does nothing. This one IPO'd and tanked. Went all the way down, lost 50% in the following month or so. And, yes, it can go below 10 now because this is a new company. This is not a SPAC with that protection anymore. It IPO'd under the new company. Now it is a company just like any other stock ticker out there. And so it started dropping and tanking. And if you try to invest in this one, you're now, down or underwater. Maybe you just tried to play the hype regardless. And so you were down money. Now it did eventually recoup that, get a nice little momentum in here. Obviously, like I said, this became a stock ticker. So now it's prone to earnings. It's prone to headlines, contracts, every other stock. Yes, this used to be the acquisition from a SPAC, but now it's a stock. You need to be looking at this as a company like every other company out there. But in that SPAC process and that announcement process and such, a lot of opportunity is generated. Now, I could sit here and continue to show you electric car vehicle companies, but there's way too many to show you. Just look at some of those tickers if you want to see more. NKLA, SPE, QS, HYLN, FSR, CIAC, RIDE. I could probably list off, I think, like 24 probably off the top of my head after thinking for a little while, because there were a lot this year. Yes, there could be appealing non-electric vehicle SPACs, whether investing or day trading. Utz. If you eat Utz or know what Utz is, it's a food brand company. This looks like a pretty bullish chart. They've had some good day trading opportunities in here. IPOB, this is a great one. Open Door. If you've gone to the restaurants and you know how to set reservations through Open Door, this is Open Door. And I don't know if this one's actually, yeah, this one hasn't even gone public yet. This is one that, they announced. It's great. It's up. And at some point we'll get the merger date. I don't believe it's merged yet, but when it does, we'll probably see a little more movement. And then after that, it could go to zero. It could go wherever it wants, but we're getting day trading opportunities off of it. And DraftKings. This is after it went public on the SPAC. If you want to see the SPAC on this one, you have to actually look up its old SPAC. I don't remember what it was, but we've gotten a lot of opportunity from DraftKings. This was a real company, and look, it's not an electric car vehicle company. So there's a lot of opportunity out there. There's all sorts of different kinds of SPACs. So in closing here, because I don't want this to go too long. We're already over 30 minutes. SPACs are, kind of the new hot thing this year. And that hot thing is going to carry into next year. It's not over yet. And if you want to invest in them, the only thing I can stress is due diligence. You're going to need to do some further learning. Yes, I'm hoping that I taught you some things here, got you at least started on the path of looking into these things. Maybe it's something that interests you a lot. If you're not interested in investing them, that's fine. They provide so much trading opportunities. And yes, you might need some luck in this case because you could have done all the due diligence you want. Bill Ackman has come out with this hot new SPAC, billions and billions of dollars. 2 years goes by. What if he's an asshole and no one wants him to buy them? What if his terms are terrible and no company is willing to go public through his SPAC? Then guess what? That was 2 years wasted, a lot of capital wasted. So, there is going to be, to a degree, but that's just like the market. There's always going to be an aspect of luck in the market. But in the meantime, there's going to be so much opportunity in day trading SPACs. And so it's important that you at least understand the basics of them because you need to know what you own. Know what you're trading, know, this one's popping, why, what sector is this in, what's my value here, what's my real risk, and just go out and day trade, baby. This was a day trade focus course, but there is so much opportunity in here, swing trading, investing, whatever. And this is just one of the many things that we've seen kind of surface and come front and center this year. I think it's going to cause a lot more interesting action next year, both in more SPACs and mergers or whatever. So this is your moment to learn and figure it out and get prepared for whatever is to come next. This is Nick. I really appreciate you tuning in. If you have any questions, drop them in the comment section. Be sure to subscribe. We might have more videos that come out regarding this or maybe how to trade mergers and acquisitions. And I'd love for you to get the updates on those. And I will be sure to answer any questions I see in the comments or just drop a feedback, drop me a like, and we will be here as always on YouTube. I will see you next time. And as always, safe trading.